Assalamualaikum and greetings everyone. My name is Halida binti Muhammad Salfi and I have been assigned with November 2005 for the total of 1%. So firstly, I am going to present part A first, which consists of 40 marks. So part A is mostly theoretical. So the first question is, what are the three main requirements for a viable futures market? I explain briefly. 3 marks. So, the answer for this can actually be found on page 35 of the textbook. This is the answer. You see it? This is the answer. Can be found here. So, the first one is deep market. Every futures market must have sufficient number of buyers and sellers in order to provide continuous opportunity to trade. Second one is easy trading. Since the focus is on agricultural product, the commodity selected for grading has to be easily graded and hence standardized grading. And the third one is free fluctuation. So prices must be free to fluctuate without any government control or monopoly power. Prices volatility leads to higher risks for buyer and seller. The next question is, what is spread trade? Explain the two advantages of spread traded as compared to outright position. So the definition of spread trade is a strategy in which a trader simultaneously buys and sells two related financial instruments to profit from the difference in their price movements. So the advantages of spread trade, firstly, is reduced risk and volatility. So spread trade typically involves lower risk and volatility compared to outright positions because the price movements of the two instruments are often correlated. This correlation reduces the impact of market-wide price swings since gains in one leg of the trade can offset losses in the other. So for example, gains in long leg can offset the losses in short leg. Next advantage is lower margin requirements. So spread trades generally require lower margin deposits than outright positions because they are considered less risky. So exchanges recognize the hedged nature of spread trading and offer favorable margin treatments. This advantage allows traders to control larger positions with less capital, enhancing their return on investment while maintaining a safer trading profile. So, next question is, what are the three groups of speculators? Briefly explained in terms of principle and strategies. So the first one is scalper, next one is day trader, and the third one is position traders. So what are the difference between three of them? So firstly, scalper usually hold their positions for a few seconds to few minutes, while day trader, they hold their positions, they do intraday trade, and their positions can last for a few minutes to several hours, and they don't do overnight trade to avoid overnight risks. And position traders rely on fundamentals, which their position can hold from a few days to a couple of weeks to even months. So firstly, scalper. So the principle of scalpers aim to profit from very small price changes in the short term. Their primary objective is to capitalize on high frequency trading opportunities. So their strategy is they execute multiple trades within a single day, often holding positions for just a second or minute. So scalpers rely on tight spreads, high liquidity, and quick decision making. Their focus is on accumulating small but consistent gains while limiting exposure to market risks. Next is day trader. So the principle of day trader is Day traders seek to profit from short-term price fluctuations within the trading day, without holding positions overnight to avoid overnight risk. So the strategy implied here is they analyze intraday trends, news, and technical indicators to identify opportunities. So day traders often use leverage to amplify their returns but close all positions before market closes. Their trades typically last a few minutes to several hours, depending on market conditions. So the last one is position traders. So the principle behind position traders is position traders takes a longer term approach compared to scalpers and day traders. So they aim to capture significant price movements over days, weeks, or even months. So the difference is basically position traders, they seek higher profit, like significant profit, while scalpers and day traders, they seek like very little profit. So the strategy is they base their decisions on fundamental analysis, long-term trends, and macroeconomic factors. So position traders accept higher market exposure in exchange for potentially larger profits. They focus on holding positions through market fluctuations, believing in the strength of their long-term predictions. So question 1D is, a fund manager is expecting funds worth 10 million ringgit in December 2005. He feels that KLSE index will slowly rise to 900 from current level of 850. He wants to lock in his entry level now rather than to wait until November. Using the information below, answer the following questions. So the spot KLCE index is 850 and December FKLI futures is at 860. So given the information above, what should he do to protect his action? Next is calculate the number of FKLI needed to use in hedging strategy. So as we can see here, he feels that KLSE index will slowly rise from 900 to 850 to 900 from 850. So basically, when price is rising, the fund manager should adapt long hedge trading strategy. Okay, so this is the answer. Use long hedge trading strategy to mitigate the risk of the index rising. The fund manager anticipates the KLSE index to rise, so he needs to buy FKLI futures contracts now to lock in the current price. By entering into long futures contracts, he ensures that if the index rises, the gain in futures will offset the higher price he would have to pay in the spot market. So basically, in the cash market, he will plan to buy constituents first at T0. Then if the price rises as expected at T1, he can use the profit derived from futures market to offset the buying price at spot market. So the second one is calculate the number of FKLI, so basically the number of contract. So the formula for the number of contract for FKLI is, this is the total exposure. Oh, I'm so sorry. How do I do this? So this is the formula. So this is the formula for the number of contract for FKLI, which is, this one is total exposure, this one is percentage of hedge, and this one is the beta. So the formula is basically total exposure times percentage of hedge times beta divided by the index points for selected contract month times contract size, which is 50 ringgit for FKLI. So the answer for this is 235.29. We have to ignore the decimal points. So the number of contract is 235 FKLI December contracts. Don't forget to put the contract code and the contract month. So the next question is, what are the choices that the holder of the call option has? So they have 3 options, which is firstly, exercise the call option, sell the call option, or let the call option expire. So firstly, exercise the call option. The holder can choose to exercise the option if the market price is higher than strike price. So strike price is exercise price. So by exercising the option, the holder buys the underlying asset at the strike price, securing an immediate profit equal to the difference between the market price and the strike price minus the premium paid for the option. So basically, this is actually for long call. Wait, let me draw the diagram first. Okay, this is the diagram. I'm so sorry. Okay, so this is for example. This is the BEP. This is the EP. Okay, so this is the EP, this is the BEP, and if the market price is more than strike price, okay, so here is the direction of the market price. So if the holder exercise the call option now, the holder can secure immediate profit. Okay, actually not necessarily profit if it's in the money, but over here this is the loss gradually decrease area. So not only to secure immediate profit but also to reduce the loss. So the second one is sell the call option. So if the call option is in the money, this one is in the money, the holder can sell the option contract to another trader instead of exercising it. This allows the holder to realize profit without having to take ownership of the underlying asset. So let's say FCPO. So the underlying asset of FCPO is crude palm oil. So just sell the CPO to others so that you don't have to take that CPO, just take the profit. So next is let the call option expire. Okay, if the call option is out of the money, the holder can choose not to exercise the call option. In this case, the loss is limited to the premium paid. Okay, let me draw another diagram. Okay, I'm so sorry if it's ugly. I'm so sorry. Okay, so this is the BEP. This is the EP. So if the call option is out of the money, here is OTM. You can choose not to. Okay, wait, this is the premium. Okay, let's say the BEP is 10 ringgit, the EP is 9 ringgit 50 cent, and the premium is 50 cent, just as an example. Okay, let's say if the market price is 8 ringgit 50 cent. So to calculate profit or loss here, we just have to market price minus BEP. So the market price is 8 ringgit 50 cent minus BEP 10 ringgit. So the loss here is 1 ringgit 50 cent, which is more than premium paid. So just let the call expire, because if it is out of the money, the loss is limited to the premium paid only. So the loss will be capped at 50 cents instead of, if you exercise it, you have to bear the loss of 1 ringgit 50 cents instead of only 50 cents. Okay, next is question 2b. An investor buys a put option of Pro10 Berhad at a strike price of 8 ringgit and paid premium of 50 cents per share. The current market price is 7 ringgit 50 cents. So what is the investor's rationale for entering into the strategy? Show the investor's break-even point. Construct a payoff graph for the above strategy. If the current market price goes up to 10 ringgit, what is the profit loss payoff for the investor? If the current market price declined to 5 ringgit, what is the profit loss payoff for the investor? So firstly, this is the EP. Oh, I'm so sorry, it's so ugly. This one is the premium. So we have to find. Yeah, so this is long put. This buys and put. So this one is long. Okay, this one is long. Okay. So the answer is, the rationale is bearish on underlying, because this is long put, so bearish on the underlying. Basically the investor is expecting the price of Pro10 Berhad share to fall before or on maturity date of the options. So to calculate the BEP for long put is basically exercise price minus premium, which is 8 ringgit minus 50 cents equals to 7 ringgit 50 cents. So in order to construct a payoff graph for the strategy, we have to we have to extract the relevant parameters first. So we have to find EP, which is 8 ringgit. The outlook for long put is basically unlimited profit and limited loss. So the profit is unlimited, loss is limited, and the max loss is capped at premium paid, which is 50 cents. So the BEP is 7 ringgit 50 cents. So we have all the information now. Just construct the payoff diagram. So this is the payoff diagram. So this is the ITM, this is the ATM, this is the OTM. Don't forget to label that. So the shape of the graph should be like this. For long put, it is like this. Okay, so this is the EP, this is the EP, this is the BEP, and this is the premium. Okay. Okay, so the payoff profile for this is unlimited profit when market price is less than BEP. So this is BEP, unlimited profit starts here. So this is the unlimited profit area. So loss, limited loss when market price is higher than EP. So when market price are higher than EP, this is it. This is limited loss. So max loss is capped at premium paid, which is 50 cents, and loss will gradually decrease when EP is higher than MP is higher than BEP. This is the area of EP higher than MP higher than BEP. So we have ITM, we have OTM. Now the ATM is BEP, which is 7 ringgit 50 cents. Okay. Wait, what is the question again? Let me see here. Oh, okay. If the current market price goes up to 10 ringgit, what is the profit loss? Okay. Okay, so if the current market price goes up to 10 ringgit, this is the price that will hit the OTM, which is the part where the loss is kept at premium paid. So basically the answer is max loss is kept at 50 cents. Okay, so we have to find, oh I'm so sorry. Okay, so we have to find the profit and loss when the price declined to 5 ringgit. Wait, let me clean this up first. So when the profit or loss is at when the market price is at 5 ringgit, so this is 5 ringgit, which is in the money. So the formula to this is BEP minus market price, which is 7 ringgit 50 cents minus 5 ringgit, which you will gain the profit of 2 ringgit 50 cents. So next question, oh, we already moved on to the next part, which is part B, which consists of 60 marks. So the first question is, suppose on April 15, 2005, a trader goes long for 10 June KLSE futures contract and short 1 June Nikkei 225 futures contract. What kind of strategy is implemented above, and why does the trader undertake such strategy? So I'm going to underline this wait, I'm so sorry, I will bulletkan instead futures and futures. So when this is futures, it means this is spread trading strategy, because spread trading strategy involves taking positions in futures contracts of two different underlying indices. So in this case, it is the KLSE index and June Nikkei. Oh no, I mean the Nikkei. This is the Nikkei one only. The Nikkei is, I think, Nikkei 225 is Japan and KLSE is Malaysia. Okay. Next question is, why does the trader undertake such strategy? Okay. Firstly, because of the profit from relative price movement. So the trader aims to profit from the relative price changes between the two markets. If the trader expects the KLSE index to outperform Nikkei 225, the long positions in KLSE index futures and short position in Nikkei 225 futures will capture the difference in performance. Second one is hedging against market risk. By trading interrelated markets, the trader reduces exposure to overall market risk. For example, if global equity markets fall, losses in one leg of the spread may be partially offset by gains in the other. Okay, the third one is diversification of risk. It allows the trader to diversify risk by betting on the relative strength or weakness of two different indices rather than depending on absolute price movement of a single index. Or we also call it as being naked. Next is question 1B for part B. Consider the following date for calculating the price of crude palm oil futures. So July 2, 2005, the spot price is RM 850 ringgit per metric ton. The September CPO futures price is at 1000 ringgit per metric ton. The dividend yield is at 8.5% per annum. Borrowing rate is at 10% per annum, and storage cost is at 60 ringgit per annum. So the questions are: calculate the theoretical value and state whether an arbitrage opportunity exists for 500 tons of crude palm oil. Explain your strategy and calculate the profit loss you would make from your arbitrage strategy. So firstly, the first step to calculate the arbitrage here is calculate the fair value first. So in order to calculate the fair value, you must find n first. So to calculate n, so the wait, what did it say again? July 2, 2005. So from 2 July to 31, we have 30 days, and then August 1 to 30 days, and then September 1 to 15, which is 15 days. So 30 plus 30 plus 15 equals to 75 days. Okay, so why 15? Why here in September only 15? Because the last trading day for FCPO is at the 15th. So we just put everything inside the formula. So the formula is spot price times 1 times interest times n per 365 plus cost times n per 365. Okay, so the spot market price is 850 ringgit. So 850 ringgit times 1 plus 8.5% dividend yield. So this is the dividend yield. Next is the n, which is 75 days, times plus 60 ringgit. Okay, usually to calculate the storage cost, usually we time it with 12. For example, 60 times 12, because we want to calculate it for so borok. Okay, 60 times 12, usually, because we want to get the storage cost per annum. However, the question already stated the storage cost per annum, so no need to times 12 because it is already per annum. Okay, so the answer for this is 877 ringgit 17 cent. So we make comparison. So the second step is we make comparison for fair value versus the actual price. So the actual price is 100 ringgit per metric ton. Okay, so 877 ringgit 17 cents is lower than 1000 ringgit. Therefore, the value discrepancy for it is overvalued. Okay, usually it will be overvalued because overvaluation is more common due to speculative demand, cost of carry assumptions, and market dynamics like premiums and leverage. This is why traders often engage in reverse cash and carry arbitrage. So what is reverse cash and carry arbitrage? Basically, buy cash market and short futures market. Okay, so buy CPO at cash market and short FCPO at Bursa Malaysia Derivatives Berhad. Since the actual futures price RM1000 is significantly higher than the theoretical price 877 cent, an arbitrage opportunity exists. Okay, next we have to explain the strategy. So the strategy is the arbitrage trade strategy. Okay, firstly for T0, which is in July, we need to have P, R, and T. So borrow money, which is cost of purchase, at 10%. That is the R. For 75 days, that is the T. So buy 500 metric tons of CPO at 850 ringgit per metric tons. So store CPO at warehouse for 75 days. So annualized cost is 60 ringgit at BMDB. We short 20 September FCPO contracts at RM 1000 ringgit per metric ton. So the NOC is 500 metric tons divided by 25 metric tons, which equals to 20. This is the contract month, this is the contract code. Okay, at T1, take out the CPO from warehouse and transport to designated port and then pay back the loan. For BMDB at T1, deliver 500 metric tons of CPO at designated port. So the designated port is at 3 places, at Lembah Kelang, Butterworth and Pasir Gudang, as per instructed by Bursa Malaysia Derivatives Clearing. So next is calculate the profit loss from the arbitrage strategy. So firstly, we have to calculate the cash market position. Firstly, COP, the cost of purchase, which equals to price times number of metric tons, which is 850 ringgit per metric ton, times 500 metric tons, which equals to 425 ringgit. Second, we have to calculate the interest cost, which is I equals to PRT. So the P, you take P from up here. This is the cost of purchase, which is the price. So this is the price. P times that one. P times 10%, which is the R, and T, 75 T's. Don't forget to per T 165. So the answer is 8,732 ringgit 88 cents. And the storage cost is the annual storage cost times number of metric ton times N. So the annual storage cost is 60 ringgit per metric ton at 60 ringgit per annum. I'm so sorry, it's 60 ringgit per annum times 5 ringgit per metric ton and times 75 per 365, which equals to 6,164 ringgit 38 cents. So the cost of arbitrage is basically A plus B plus C. So A plus B plus C, in which you will get the answer of 439,000 ringgit 897.26 cents. Next, calculate the futures market price, which is sales revenue equals to price times number of contract times contract size. So the price is 1,000 ringgit per metric ton times 20, which is the number of contract, times 25 metric tons, which is the contract specification for FCPO. And you will get the answer of 500,000. 500,000. Okay. So next is calculate the arbitrage profit loss, which equals to sales revenue minus the cost of arbitrage. So the sales revenue is 500,000 ringgit minus 439,897 ringgit 26 cents, which will equal to the total profit of 60,102 ringgit 74 cents. So, next question. Okay, so next question 2A of part B. An equity dealer takes the view that the Bursa Malaysia Kuala Lumpur is likely to rally over the coming week. To take advantage of this view, the traded long 12 November KLSE Composite Index futures at a price of 1,125. Prepare a marked to market position to show the variation, gains or losses given the following closing prices. So these are the given closing prices for day 1 to day 5 to day 6. So just construct the daily mark to market table. So for the T-Day, the trade description for T-Day, long 12 December FKLI and deposit initial margin as required by BMD. So the current price is 1125 points. And then for T plus 1 to T plus 5, no new trade holds positions. So usually in the table you will usually have other columns such as margin account balance, margin call, and margin account balance adjusted with margin call. But since they only want the profit and loss, so we just have these columns. Okay, so to calculate the profit or loss, the formula is, wait, I think I can insert text here. Add a text box. Okay. Oh, I'm so sorry. How do I do this? Add a text box. Okay, so the formula for profit and loss here is selling price minus buying price times number of contract times contract size. So this is the formula. Okay, so the selling price is the I'm so sorry, wait a second. The current price is the selling price. Oh wait, how do I do this? Okay, one sec. Okay, so the current price will be the selling price and the prior price will be the buying price. So for example, we want to calculate for T plus 1. Just put 1120 minus 1025 times 12 times this is FGLI, so figuring it. Selling price. Wait a second, I can't see. Oh, I'm so sorry. That was 100 times 12 times 20, 50. Okay, we get the answer of 3000. This is the loss. So to get the total profit or loss, just add everything in the profit or loss column. Therefore, you will get the answer of 8,400 ringgit. So to double check, you can also just use the formula of this. This is the formula. Oh my god, I already written the formula. Okay, so this is the formula for the profit and loss. So just take the last set. Wait. So just take the last selling price and the first buying price. So this is the last selling price and this is the first buying price, and you will get the answer, the same answer, which is 8,400 ringgit. So next question 2b. Explain how natural market forces act as a buffer against what discrepancies between cash and futures market in the delivery month. So the answer is, in the delivery month, the price of futures contract and the price of the underlying cash market asset tend to converge due to arbitrage activities and market dynamics. So wait, let me draw another one. So, oh my god, wait, let me draw this one again. Okay, I'm so sorry. Okay, so this one is T0, this one is T1. Okay, so the price of futures and the price of underlying cash market tend to converge. So here, this is where the price will converge. Okay, so the arbitrage opportunities. If there is significant price difference between the futures and cash market, the traders can profit by arbitraging. So there's two situations. When futures prices are higher, traders sell futures contracts and simultaneously buy the underlying assets in the cash market, which is going to push futures prices down and cash prices up. So this is the first scenario where the futures price is higher than CP. Okay, this is also called normal market, where supply is more than demand. The second situation is when futures prices are lower. So traders buy futures contracts and sell the underlying asset, which is causing the futures prices to rise and cash prices to fall. So this is the second scenario. Futures price lower than cash price. Okay. So under here we also call it as backwardation or inverted market, where demand is less than supply. Okay, next question. Differentiate between over-the-counter and exchange traded. So I'm going to three aspects, which are the standardization, transparency, and counterparty risk. So firstly, what is over-the-counter? So over-the-counter was also formerly known as pink sheet trading. So pink sheet trading is done between two parties without the supervision of an exchange. So firstly, the first aspect is standardization. OTC contracts in Malaysia are customized based on specific needs, such as forward contracts between local businesses and banks. For the exchange traded, Bursa Malaysia offers standardized contracts such as the FKLI and FCPO. So what do you mean by standardized? Okay, usually they will have a standardized contract size, a minimum price fluctuation, contract month, trading hours. Yeah, that's what I mean by standardized. Okay, so transparency. OTC markets in Malaysia, such as private placements or interbank money markets, have lower transparency. So prices and volumes are not publicly disclosed. For exchange traded, Bursa Malaysia ensures high transparency with real-time prices and trading data available to all participants. So third aspect is counterparty risk. So OTC contracts in Malaysia rely on the creditworthiness of counterparties, such as local banks. No clearinghouse is involved, increasing default risk. So for exchange traded, Bursa Malaysia reduces counterparty risk through its clearinghouse, which is Bursa Malaysia Derivatives Clearing, which guarantees trade settlement. So next question is the third question of part B. Clearinghouses and derivatives exchange is known as self-regulatory organizations. Explain what is meant by self-regulation. So the definition of self-regulation is self-regulation means that the organization has the authority to regulate its own operations and members without direct government control. These organizations set rules to ensure transparency, integrity, and fair practices within the market. So the functions of self-regulation is to enforce market rules and standards of behavior, monitor market activities to prevent fraud or manipulation, ensure market participants comply with ethical and operational standards, and providing dispute resolution mechanisms for members. So for example, a clearinghouse like Bursa Malaysia Derivatives Clearing Berhad ensures that all trades are settled and monitors compliance with margin and collateral requirements. It acts as a guarantor for transactions, which is going to reduce counterparty risk. So next question is, describe the power of Minister of Finance as prescribed by Futures Industry Act 1993. Okay, so the Futures Industry Act 1993 has been replaced by Capital Market and Services Act 2007 because this past year is so old. It was at 2005. Now now they already use the new one, which is Capital Market and Services Act 2007. So what are the power described of what is the power of Minister of Finance? So firstly, approval and licensing. The Minister of Finance can approve the establishment of futures exchanges, clearinghouses, and brokers. Minister of Finance also can grant or revoke licenses for futures brokers and market participants. Second, rule amendment and oversight. Approving, amending, or rejecting rules and regulations proposed by the futures exchange or clearinghouses. Next is to ensure these rules align with public policy and investor protection standards. And the last one is market surveillance, where Minister of Finance direct regulatory bodies or exchanges to conduct investigations into market activities. And Minister of Finance can act against malpractices or breaches of the law, such as insider trading or market manipulation. So next question. Consider the following payoff diagram. What is the break-even point? What is the options premium? What is the exercise price of the option? What is the strategy being depicted in the payoff diagram? So the break-even point is the line that touches x-axis. So this is the break-even point, which is RM 7.50. So the options premium. The option premium is this one, the one from y-axis, which is 100 cent. And exercise price. Exercise price is the one here. This is the exercise price, which is 8 ringgit 50 cent. And the strategy being depicted, okay, so this is short put strategy. Okay, next question. Briefly explain the differences in risks taken by the buyer and seller of an option. So basically, okay, I'm going to talk about the risk and reward for buyer and seller. For the risk for buyer's maximum loss is limited to the premium paid, regardless of how unfavorable the market moves. However, for the seller faces potentially unlimited losses for call option if the underlying asset price rises significantly, or substantial losses for put option if the price falls sharply. For the reward for buyer, the buyer has unlimited profit potential for a call option if the market moves significantly in their favor, or substantial profit potential for put option if the market drops sharply. For seller, the seller's profit is limited to the premium received from the buyer regardless of how unfavorable the market moves. So basically, buyer of an option pays premium to purchase the right, but not the obligation to buy call option or sell put option, which is put option, the underlying asset at a predetermined price. So for example, a call option buyer benefits if the underlying asset price rises above strike price, and a put option buyer benefits if the price falls below the strike price. Okay, for the seller of an option, the option seller, which is also known as writer, receive premium from the buyer in exchange for the obligation to fulfill the contract if the buyer chooses to exercise the option. So for example, a call option seller loses money if the underlying asset price rises significantly, while a put option seller losses if the price falls well below the strike price. Okay, Next question. Question 4. Okay, let's go. This is supposed to be the last question for part B, I think. Oh wait, no. Okay. This is the Mukarima. On July 12, 2005, Perkayuan Pantai Timur Sdn Bhd knows that it will have to borrow 12 million ringgit on September 14, 2005 for 3 months. Bank Berhad agrees to provide these funds at 1.5% above whatever the 3-month CLIBOR is on that particular period. So the last trading day of 3-month CLIBOR futures contract is also falls on September 14, 2005. Perkayuan Pantai Timur Sdn Bhd is concerned that the CLIBOR may rise. So what do you think the firm will do to protect itself against the rising interest rates, assuming the following information is available? So the CLIBOR rate is 8.20% and the 3-month CLIBOR rate is 91.80. So on September 14, 2005, the 3-month CLIBOR futures converge with CLIBOR at 9.20%. So what is the effective interest rate for taking such action? Show your workings, and lastly comment on your outcome of the second Roman. So firstly, the Perkayuan Pantai Timur is concerned that the CLIBOR may rise. So when the firm is concerned about potential rise in FKB3, it will increase the cost of borrowing. So to hedge against this risk, the firm can use FKB3 by taking short position. So why short position? If the CLIBOR rate rises, the futures price will fall. By shorting the futures contract, the firm profits from the decline in futures prices, which offsets the increased borrowing cost. So this is the establishment of short hedge. So on T0, in cash market, need to borrow RM 12 million ringgit in September. So the current interest rate is 8.20%. Oh, I'm so sorry. So this is the current interest rate. Next is expected interest rate to increase. Yes. So price index will fall and hence selling is recommended. So for futures position, open position, and then short 12 September FKB3 at 91.80, which is quoted in index term of 100 minus yield. You can actually find this on page 106. This is actually the contract size. This is the contract size for FKB3. You can see it. Yeah, see that this is it. You can refer to page 106 of the textbook. Okay, so number of contract is basically amount of principal divided by contract specification. So 12 million divided by 1 million ringgit. So 1 million ringgit is the contract specification for FKB3, which equals to 12 September FKB3. So we have the contract month and the contract quote. Okay, for T1, which is in September, the firm will borrow 12 million ringgit at high rate of 9.20% plus 1.5%, which equals to 10.7%. Higher rate means higher interest cost. Okay, wait. So it did say that the rate will converge at 9.20%. However, remember at the beginning, it's the question say that Maybank Berhad will agrees to provide these funds at 1.5% above. So we have to add that to calculate the percentage of interest. So for close-out position, long 12 September FKB3 at 90.8. So basically just 100 minus 9.20%, which is the converged rate. So next, calculate the effective interest rate. So firstly calculate the cash market position, which is I equals to PRT, but this is interest expenses, so make sure this is cash outflows. So I equals to PRT, so the principal is 12 million ringgit. The rate, again, as I mentioned, is 10.7%. The one we have added with the Maybank Berhad rate. And the PRT is 90 per 360. Why 90 per 360? Because this is 3-month CLIBOR. So the T is 90 per 360. Okay, so just multiply PRNT and you get RM 321,000. So second is a futures market position, which is the formula is selling price minus buying price times 100. Why 100? Because multiplied by 100 in order to be expressed in the form of basis point times number of contract times RM25. So why RM25? The futures market position is multiplied by 25 ringgit because the FKB3 contract has a fixed tick value or contract multiplier of 25 ringgit. So this is a standard specification set by the Bursa Malaysia derivatives to determine the monetary value of price movements in the contract. So 91.8 minus 90.8 times 100 times 12 times 25 ringgit, you will get the answer is 30,000 ringgit. So next, calculate the net effect, which equals to interest cost minus profit from futures. So the interest cost is 321,000 ringgit minus 30,000 ringgit, which is equal to 291,000 ringgit. So futures profit, this 291,000 ringgit, which is the futures profit, will be used to reduce the payment of interest. This means that effectively the company is paying 291,000 ringgit as opposed to 321,000 ringgit in the form of interest expense. So now the company only needs to pay this instead of this. Okay, next, effective interest rate. So the formula for EIR is net borrowing cost divided by principal times T. So the net borrowing cost is 291,000 ringgit divided by 12 million ringgit times 360 per 90, which equals to 0.097 or 9.70% per annum. So the third Roman comment on your outcome. Okay, so basically the analysis. So the analysis on this is, okay, wait a second. As you can see, the EIR for naked is 10.7% compared to compared when you hedge, which is 9.70%. Basically, basically hedging objectives has been achieved. By hedging, the firm achieved a 1% savings on its borrowing costs and effectively protected itself against rising interest rate, hence reducing its cost of borrowing. So therefore the effective interest rate is only 9.70% as compared to 10.7%, which is unhedged or naked. Okay, next question. Okay. Is it possible to gain if the KLSE index futures is trading lower than its theoretical fair value given by the cost of holding stock? If so, describe the strategy a trader could use to take advantage of this situation. Okay, so basically, yes, it is possible to gain if the KLSE index futures is trading lower than its theoretical fair value. This situation presents an arbitrage opportunity and trader can use cash and carry arbitrage. So usually, as I said, reverse cash and carry, reverse cash and carry, reverse cash and carry is when you buy cash market and short futures market. For cash and carry, the normal cash and carry, you just sell cash market and long futures market. So firstly, determine the fair value of the futures and execute the trade by going. Wait a second, I'm so sorry. Oh my bad. Oh yeah, by going short in the cash market and long in the futures market. Okay, so I was right. So hold until futures expiry. The futures price will converge to the spot price of the index at maturity. So at expiry, close out the position at fair value. So the profit is the difference between theoretical fair value and the lower market price at which the futures were bought minus transaction cost. So again, basically, yes, it is possible just to arbitrage, to exploit the basis, which is the difference between cash market and BMDB. So basically, trader will simultaneously buy the future contract to benefit from the eventual rise in futures price to fair value, and second, sell spot market. So why this work? The market corrects itself as traders execute this strategy, causing the futures price to rise and converge with the fair value. The trader locks in a risk-free profit by leveraging in the price discrepancy. So this strategy is an effective way to exploit the mispricing futures relative to the cost of carrying the underlying index. So let me draw this again. So this is T0. So basically the situation here is when the market is in backwardation or inverted. So basically the futures price is trading lower than its theoretical value. So this is the price mismatch. I'm so sorry. So this is the price mismatch. Price mismatch. So when the market will correct itself at T+1, which is going to cause the futures price to increase. to rise, and it will converge with the fair value. Basically, that's it. Alright, so next question is, okay, thank you all for watching. That's it for me. Okay, that's it for me. Thank you very much.